As you invest over the course of your career, you will hopefully build enough wealth to support yourself in retirement. That is the goal. But as you get older, you will eventually get to the point where you need to take required minimum distributions. That means you must withdraw a certain amount from your retirement plans with tax-deferred contributions. That includes your IRA, your 401k, and 403b. You must take your first RMD by April 1st, the year after you turn 73. You will then be required to take another RMD by December 31st that same year. And then you will be required to take additional RMDs every year. If you don't, you may have to pay a 25% tax on the amount not distributed as required. But that's just for the current batch of retirees. For those who were born after 1960s, well, yeah, after 1960, for those birth dates, you won't be required to take your first RMD until you turn 75. In order to calculate a required minimum distribution for a single IRA holder, you take the total balance by the end of the previous tax year and divide it by the IRS's life expectancy for your age. For example, if you turn 73 in 2025, the IRS thinks you will live an additional 26 and a half years, making the required minimum distribution on savings of $200,000 just over $7,500. The calculation can vary depending on what type of accounts that you have or the age of your spouse. So make sure to check with your financial advisor. You can also scan the QR code below to find out more about RMDs. Well, we're going to help you get retirement ready and talk about required minimum distributions, known in the personal finance world as RMDs. And today, you ask the questions in Ask Finance Everything. Ask Yahoo Finance anything. We have a whip-smart team to answer your RMD questions. And joining me now, we've got Yahoo Finance senior columnist Kerry Hannon. Also with us is host of Yahoo Finance's Decoding Retirement video podcast, Bob Powell. Kerry, let's start with you. Just first, from all the folks writing into you, what's the thing that confuses them the most about RMDs?
Yep, Brad, I'd have to say the big one is like, when do I have to take them, right? It's confusing for people about, when the specific thing. And as we discussed, it's, April 1st of the year following. If you turn 73 this year, it'd be next April. But you can take them by December 31st this year. If you turn 73 this year, you can go ahead and take it by December 31st. That's what really trips people up. But here's the beautiful thing is, to tell you the truth, you don't really have to do this on your own, do that calculation. Generally speaking, your financial services company, where your IRA is or your 401k, will do this calculation for you. And they will usually let you know by the end of December what you're going to have to pay out that following year. And you can make the decision. Do I want to automate? Do I want to automate it? How often do I want to take money out of the accounts? And should they go ahead and withhold the taxes for you? And most people will say, yeah, go right ahead and do that. There is an exception to this, Brad, that I like people to remember, that if you are still working at the employer where you're paying into that 401k plan or what have you, you don't have to take your required minimum distributions in general until you do retire. So that's one exception to this. But really, that's what trips people up. So again, reach out to your accountant, talk to the plan administrator where your money is, and they can help you work through this.
Kerry, one of your readers wrote to you and asked, the stock market was up last year, and so were my retirement accounts. Will my RMDs be the same or more than last year?
Sorry, Charlie, they're going to be more. It's the thing is, that's the point, is higher returns on your investments translate to higher RMDs, because we discussed that calculation. It's how big your account was at the end of December. So that's what you're going to pay for 2025. You're going to be based on what your account was worth at the end of 2024. So, the S&P was up, what was it, something like 23%. So yes, indeed, they will be a bit higher, but that translates because you did really well last year.
Bob, turning to you, a topic that you're interested in is a new rule regarding RMDs when someone has multiple IRAs and wants to do a Roth conversion. So what is the new rule and how do people navigate it?
Yeah, it's a wonder why anyone owns an IRA, Brad. But here's the final regulation. It states that all of your IRAs are now viewed as one giant, massive IRA for RMD purposes. Now, historically, you could satisfy the RMD for a specific IRA and then convert any remaining funds in that IRA into a Roth. But under the new rule, all of your aggregate RMDs from all of your IRAs must be fully satisfied before any distribution from any IRA can be converted into a Roth IRA. And if you convert money from an IRA before you do all that, you could be subject to a 6% excess contribution penalty on the improperly converted amount.
Bob, I've got another one for you here because, it's about the 10-year rule with IRAs. People who inherit an IRA from a parent or other relative have to empty that account within 10 years of their death. But how the money is taken out during those 10 years, it differs around whether that person had started taking RMDs. So can you please explain these scenarios and tell viewers what they need to do?
Yeah, I'll try and simplify it, Brad. So the new final regulations clarify the distribution requirements during the 10-year period. It depends on whether the original IRA owner died before or on or after what's called their required beginning date. So if the IRA owner died before their RBD, the beneficiaries do not have to take any RMDs during years 1 through 9 following the owner's death. They simply have to empty the entire account by the end of the 10th year. Now, if the IRA owner died on or after their RBD, they have to take what's called an annual stretch distribution during years 1 through 9, and then take out the remaining balance by the end of the 10th year. So it's a little complicated because we've now added another acronym into the mix here. We've now, in addition to RMD, we've added RBD into the mix. So my advice would be it's best to talk to a professional if you inherit an IRA.
Kerry, I got 30 seconds or less. Another one of your readers asks, can I use my RMD to make a charitable donation? What say you?
Yes, indeed. If you are charitably inclined, absolutely, you need to make that. It's called a qualified charitable distribution. The money needs to go directly from your IRA or your account to that nonprofit. Don't come to you, go straight there. Make sure your accountant knows about so it's not counted as income, and that money doesn't get taxed. So yeehaw, you make a big bang with your buck with that nonprofit. And I think it's a wonderful thing. There are some limits. I think it's up to $100,000. You can do that. IRS has a few things around this, but it's really a great option for people.
All right, AMAs ran, so AYFAs could sprint here. Ask Yahoo Finance. Anything addition with Kerry and Bob? Thank you both so much answering some of those key burning questions from our viewers and readers. Appreciate it.
Thanks, Brad.